Hi, everyone. My name is Ben Bartolome. I'm the CEO of a startup called Walkthrough and a friend of Patricia's. And so I'm really glad and excited to be able to share this information with you all today. Let me give you guys some context on everything that we're up to on our end and why I'm chatting with you here. Um, so Walkthrough is a startup that's dedicated towards creating actionable and tailored financial planning and wellness for everyone, and especially those who might not be able to afford it. And the way that we came to creating this company is the following. So let me give you some context. So I was born in the great city of New Orleans in Louisiana, and through a variety of extraordinary things in my life, I was able to matriculate to Yale University in the great state of Connecticut. And that's where I met my two co-founders, Megan, who's from Colorado, and Eric, who's from Chicago. And the three of us have known each other now for about a decade, actually, which is kind of crazy to say. Um, and after leaving Yale, at least for myself personally, I can say that I worked in finance the entire time. So I've worked in finance the past 6 years. First, moving to the DC area, where I worked at the Navy Federal Credit Union, which is the world's largest credit union. And I was a data scientist for them there. And then I was there for about 5 years and have since moved to Pennsylvania, the Philadelphia area, where I now work on Walkthrough with Eric and Megan. And how do we come upon the idea for Walkthrough of giving everyone a financial wellness and planning? And it was through my 6 years of working in finance that I started becoming sort of a point person in for my friends, my family, my community. And I was getting lots of questions along the lines of, how much do I need saved in my emergency fund? And, should I pay off my credit cards first or should I save for retirement? And what about things like life insurance or, even, having a will or estate planning and all these things. And so, there's so many facets and so many considerations to be had here. But I realized that and especially after chatting with my co-founders, that we really thought that software could help answer a lot of these questions. That if you connected your accounts, and if things were presented in an elegant way, where you kind of are set on your roadmap and done in a very visually stimulating way, and you had tailored guidance of what you needed to work towards for your specific situation, and then have that be motivated and illustrated with how, as you complete certain financial tasks, the impact that that has on your financial future, and being able to all track it all in one place and really try to get at 90+% of the questions that a human financial planner generally goes through with one of their clients, and do it on a way that is really cheap. We would be able to really serve folks quite well. And so, yeah, that's the mission. And I will be taking some of the content that we have and walk through and going through some interesting things with you. So I mainly want to talk to you about compound growth and the principles of investing. So first, let's go through a few scenarios to illustrate really how kind of unintuitive a lot of investing might be in terms of how quickly your money can grow over time. And so the first one is, let's assume that the stock market grows 10% on average every year, and that you're 100% in the stock market with your investments. And this is roughly what it has done over the last 30 to 40 years. And so taking some historical averages there. And that we start off with $10,000 invested at the age of 22, which is roughly when folks start graduating from college and start working. You start off with $10,000, and really the question is, how long do you think it'll take for the money to grow to certain levels? 6x, 60x, 100x, and so on. And so I'll go through an example with you here. again, you just throw in $10,000 into the stock market at the age of 22, and you can see that over this time period, we get to about 6 times this amount. What do you think the age is over here? How long do you think this would take to get there? And, I guess you would pause the video here and try to figure it out. But the answer is that it's around the age of 40 in this case that you would hit 6x. And so basically, when you're able to double your age in this case, kind of roughly, you're able to 6x your money, which is pretty cool. And you didn't really do anything here, right? Like, you put your money in and it was just able to grow on your behalf passively. You didn't add more money in, anything like that. Just the economy grew. And as the economy grew, your money grew. That's really fruitful. Let's say, what happens if you go further out into the timeline? So we know that at age 40, you have 60 grand, and you might be like, well, Ben, that is cool and all, but I don't really think that's enough for retirement. And you would be right. Let's see, what other milestones we might hit, and you can kind of look at the axis to get a perspective here. But at the age of 65, which is when, retirement tends to start being on the, on the horizon for many folks, you can see that coincidentally, and I did not rig this, but that you also have 65 times the amount of money that you started with. So you started with 10,000, and again, you're not doing anything. Your money is just growing passively on your behalf as the stock market grows. You end up with 65 times the amount of money that you started with, which is pretty incredible. And if you just wait a few more years at the age of 72, because some folks like to extend, they like to keep working, they're extending their retirement, find other fruitful things in their life that they can get paid for, you'd actually be a millionaire. And this is all, again, just starting with an initial investment of $10,000 and you haven't added anything else. What if we varied the age here and we actually invested this $10,000 a little bit earlier? I know most of you guys are in high school. And so what if we start at the age of 18? And you might say, oh, well, Ben, here at age 40, it doesn't really look like there's that big of a difference here between the performances just by starting 2 years earlier, investing $10,000. And you'd be kind of right. It's 80, you would have at if you put your $10,000 in at the age of 18, as opposed to the age of 22, you'd have 88,000. But you can start seeing how that compounds over time. And really, it's just the amount of time you let your money grow in the market. The longer you do that, the better off you'll be, generally speaking. And so if we compare at age 72, you're now at $1.7 million versus $1.2 million. And you've grown and given yourself an extra $500,000, an extra $500,000 by starting this investment 4 years earlier. And many of you might be like, well, could you start even earlier? And it is true. It's possible for minors with the permission of their parents to invest even earlier. And so let's go at age 16. We can do the comparisons again. And you can see that at age 40, it's all roughly still looking mostly the same, but it's in the end that we see that there's a big difference. And this is like one of the most striking things to me personally, that with that 10% growth in the market year over year on average, that you would end up with a $2 million outcome instead of a $1 million outcome just by starting 6 years earlier at the age of 16 versus the age of 22, which is really to say, there's no time that's too early to start focusing on your retirement, on your financial independence. And this cannot be understated. You only start 6 years earlier, but you basically double your money. And that's pretty striking. Now, most of you should be fortunate enough to not really have to just start out with your initial investment of money, right? You probably want to keep contributing to that amount over time. And so there's this question of, right, what if we add just even a little bit, $100 every month. We start scrimping on maybe eating out a little bit less, that sort of thing. But if you're able to save $100 every month and you throw it into the stock market in addition to your $10,000, and here you'll be like, oh, well, these graphs look the same. But you might notice that the y-axis is appreciably different. And yeah, let's do the comparison. So at the age of 22, you would end up with $2.6 million instead of $1.2 million using these like historical averages. And this is really striking because this 2.6 million is actually bigger than the last 2 million we saw starting at the age of 16. So it's almost like you can kind of catch up just by adding $100 a month. And obviously the more money you would add, the faster it would grow. What is at age 18? Well, again, you add in $100 a month now, and now you're at almost $4 million as opposed to just under 2. And then for age 16, you're almost at $5 million versus $2 million. And again, this is all just to say, and these are all the numbers for the age of 72, by the way, right here, right at the end. And this is all to say that it takes just a little bit of money to get started, and you just keep contributing small amounts as much as you can consistently every month, and it will pay off for you in the long run, and can functionally ensure your financial stability as long as you start early, contribute a little bit. And even if you don't get to start early, the principles are the same. You just contribute what you can, and you're diligent about it, be consistent, and you'll be in a good spot. So yeah, the summary is start saving and investing early, invest even little bits as much as you can. And then you might have this broader understanding that the time that you spend in the market, the amount of time that you let your money grow while it's invested in the market is much more important than just timing the market, which is to say, trying to be like, oh, I'm going to buy when things are cheap, or, sell when things are high, and all that different stuff. Just let your money grow. You don't even have to really look at it, and you'll be happily surprised by how quickly it can grow over time. And so you might be thinking, oh, well, this is all well and good, but how do I actually invest, right? What do I need to do here? And I can illustrate this with a few examples. So you guys may have heard of meme stocks like GameStop or AMC. If you guys followed any financial news over the last few years, the stock prices of some of these companies went absolutely bananas. And let's take one of them as an example, just to see like how difficult it can be to like really stock pick, or to like choose one or a few stocks that you think are going to be surefire winners. So if we take AMC, we have these questions of, okay, how much do they make in profit every year? How susceptible are they to like, global crises like the pandemic, or even, climate change and these types of things? How many movies do people like to go see on average? How many movies do people see in a given year? And how many of those do people actually want to see in theaters? Like, what are the kind of blockbuster type movies, so to speak? What's that kind of breakout versus, seeing them in person in theaters versus streaming? How many AMC locations closed last year? How many of them opened? What are competitors looking like? Competitors like Regal Cinemas or, Netflix and such. What about how happy are their employees? What's their employee satisfaction? Are employees quitting in droves? Are they looking for other opportunities? Is inflation eating away at their profits? Because we're in a time of high inflation right now, and prices are rising quite quickly. And then even, kind of things that are more of a reach maybe, but, what about the metaverse? Like, do people want to see movies via their Oculus headsets, as opposed to, going to see them in person and that sort of thing? And really the question is, after seeing all of these questions, the question is, do you want to yeah, like, can you do this analysis from one company? And I only gave, a small subset of questions. There's really kind of hundreds, if not thousands or more questions you might be able to ask when you're doing this sort of analysis. And do you even want to? Like, do you want to, when you get home from work, do you want to kick back and relax and chill, game or something like that? Or do you want to, deep dive into different companies and try to figure out if they're going to be a winner or a loser in the long run? And this is a pretty hard problem to solve, even among, Wall Street professionals. That, 1 out of 10 Wall Street analysts tend to beat the market in a given year, which is to say that, the market might return 10% on average, like I mentioned earlier. This person might beat it by, maybe they get 20% or even 30%. But everyone else, they might still make money, but they might lose. They tend to lose relative to the market. So they might get 5% or 7%, but they're not getting the market's 10%, so to speak. And if you just invest in the entire stock market, you'll beat 9 out of 10 Wall Street bros, which should be pretty exciting and kind of motivates the approach that I'm going to give you guys. So, how do we invest in the entire stock market? And here I'll go over a few kind of indices that people like to reference in media a lot of the time for what are kind of different segments of the stock market. So the first I'll go over is the NASDAQ, which is an acronym that stands for a bunch of words that I do not know. It's a national blah, 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 blah. And it's actually a stock exchange similar to the New York Stock Exchange. And the types of companies that are represented on the NASDAQ are, tech and innovation stocks. So most tech companies that you might think of are actually hosted on the NASDAQ. And you can think of like fast growing startups like Walkthrough hopes to be eventually. They tend to be listed on NASDAQ. And so these, high growth, a little bit more volatile stocks, tech oriented, that sort of thing. The next is the S&P 500, and this is kind of like the gold standard, so to speak. And so these are the 500 largest companies in the U.S. stock market. It's technically possible for there to be really large companies that are private, and so they are not, they're owned by private shareholders, the employees, the founders of the company, that sort of thing. But these companies are public, and so you can buy and trade their stock on different exchanges. And these are the 500 largest companies, and so you can think of Apple, Amazon, Microsoft, on. These top 500 companies capture 75% of the public market, the public stock market, the economic value for the entirety of the United States. So if you buy an index that tracks the S&P 500, you're capturing 75% of the existing value from the U.S. public stock market as a whole. And normally when you hear in media, oh, the stock market returns 10% or it's doing X, Y, and Z and stuff, they're normally talking about the S&P 500 in specific. The last one I'll go into is the Dow Jones Industrial Average. And it is as exciting as it sounds, which is to say, not particularly. It's an older legacy index that is, a weird weighting of just 30 companies. So you can see that, the S&P 500, you're kind of spread out across 500 companies. Here, you're only getting 30. Most professionals don't really think of it as representative of the U.S. stock market anymore, again, because, it's 30 out of, thousands and thousands of companies. And for whatever reason, the media like to keep talking about it just because it's like, it's existed for hundreds of years, and they're like, yeah, let's keep that going. And so, yeah, it's old, established, and that's okay. But it's important to know what it is so that when you hear about it in media, you can understand the context. And so this is all great, well and great, but can we do better than just buying a bunch of tech stocks, buying even the top 500 stocks, or especially better than buying just 30 stocks? Can we invest even more broadly? And the answer is yes. And so the approach here is that there are these funds called exchange traded funds, ETFs. You may have heard of, and they exist for all kinds of asset classes, stocks, bonds, you name it. And these funds make it pretty easy for us to invest really broadly. So you put your money into this fund, and then the fund spreads it out across thousands of companies or bonds and what have you. So I'll give you guys a few examples. So the Vanguard Total Stock Market ETF allows you to invest in the entire US stock market. And you can just Google these letters, they're called tickers, VTI. You just Google VTI, you can see the returns of this entire ETF. And you can even see like how it's allocated, based on the top 10 holdings, like how much of it is Apple versus Microsoft versus what have you. But you can buy basically the entire public stock market. That's awesome because you get to be diversified, not against 30 or 50 or 500 companies, but thousands of companies. You can also do the same thing for international markets. So you can look at these same letters, BEA, and invest in developed markets. And these are things like Japan, Europe, established international markets. You can do the same thing for emerging markets, which are also international in our our countries like China, India, Brazil, what have you. And then you can even buy an ETF that does all three of these, which is the total world stock ETF. I'm focusing on Vanguard because they tend to be very cheap and very easy to invest in. But there are other companies like Charles Schwab, Fidelity, so on, who offer these things. But the point is that they exist. You can just look up these letters, and if you have permission from your parents or you're 18 years or older, you can open your own accounts and start investing, and you can buy things that allow you to literally invest in the entire global stock market, international, domestic, for the United States, so on. We can move on to bonds, which allow us to do similar investing in ETFs, where, for example, you look up BND and you're able to purchase a wide swath of U.S. bonds that cover corporate bonds in the United States, bonds from the government. And just to reestablish, bonds are debt assets, and so it's like you're lending money to these corporations or to the government, and then the government is paying you back some interest in addition to the original amount of money invested. And so you can invest your money and basically lend it to a bunch of different companies, and to the US government. And you can do that for local and state governments, which are called municipal or tax-exempt bonds. You can do it for TIPS, which are treasury inflation protected securities, which are to say that these are securities issued by the United States government, debt instruments issued by the US government that are inflation protected and can be quite nice, especially during times of high inflation as of now. And then you can do the same thing where you can just buy total world bond ETFs, where you can also get exposure to international bonds. These bonds are all US centric. There are also ones that exist for international bonds. And you can also buy things that like BNDW that allow you to invest in the entire world's bond portfolio. Pretty incredible. If you wanted to invest in all the world's bonds and stocks, you could just buy these two ETFs and invest in them, and you get all of that diversification, all of that exposure. You don't have to worry about figuring out whether or not a given company is going to succeed or anything. As the world's economy grows, your money will grow. And so one question you might have are these percentages here, and what do they mean? And these are known as expense ratios, which is basically how much does it cost to hold this fund. So we can take actually these two ETFs here, which you can see cost 0.05% to hold. And so if you put $10,000, sticking with the example earlier, into one of these ETFs, it would cost you $5 a year, which is pretty cheap. And it's especially cheap for you to do this yourself and be an informed participant in the stock market as you're investing for your own personal short, mid, and long-term goals, as opposed to having a human financial advisor do this for you, because many of those financial planners and advisors can charge 1% of the assets they're managing for you, which would be $100 out of your 10,000. And sometimes it doesn't always sound like a lot, but when you're able to do this by yourself, you can save 20 times the amount of money it costs to have a human do it on your behalf, or you can take control and handle your stuff yourself. Save the money, be informed, and you can save 20x on your expenses for your financial management. So let me hit you with the total summary here. Summary is start saving and investing early, like I mentioned earlier. $10,000 invested at the age of 16 without even putting any more money in can be $2 million by the age of 72. Which is remarkable. You could all be millionaires if you start early. Investing even a little, like invest little bits of money, even the smallest bits, as much as you can, compounds a very big difference. And so again, at the age of 16, you put in $100 a month in addition to this 10,000 you're starting out with, and it will double your money to, or it can double your money to $4.7 million. 3, there are many indices, just like the S&P 500, that track different parts of the market, whether it's tech stocks, whether it's the top 500 companies, or 30 companies like the Dow Jones does. There are many of these, but perhaps the route to take is that stock picking, choosing one company or even a few companies in particular, can be very hard. Remember all those questions that I asked about A and C. Diversifying across thousands of companies and governments across the world is probably key, because as those respective economies grow, your money can also grow. And this should go without saying, but remember that I personally am not your guys' financial planner or advisor. So none of this should be taken strictly as financial advice. This is all just for your own literacy and broader understanding, and that you shouldn't transact or take action without being as informed as you can be, and making sure that you have someone who's fiduciarily aligned on your side to make sure that your money is being put to good use. And whether that someone is a human, which I mentioned, it can be quite expensive, or if it's a software like Walkthrough that can help you cover not only these types of topics, but so many other things, such as, well, should you invest your money in a normal account, or should it be in a tax advantage account like an IRA or a 401k, if you've heard of those fancy numbers and letters before. I mentioned you can buy stocks and bond ETFs and invest yourself really broadly, but how, for your purposes, how should that balance be? Should it be 50% stocks, 50% bonds? Should it be 100% stocks at certain points in your life, or 0% bonds? And these are really important questions, especially as you get closer to long-term goals such as retirement. How do you readjust this balance? And are there things out there that adjust it for you, which there are? Things that, as you might be going into college, like student tax credits, pragmatic things like how much do you need for like a security deposit on an apartment in order to move in, and like even choosing between like part-time and full-time master's programs if and when you finish college, and thinking about how to pursue the consideration of pursuing further education. And so yeah, I'll leave you guys with that. I'm always really happy to be reached out to. And just as like a quick reminder, like this is the mission of Walkthrough. Our app is roughly a month away from being available for folks to use and start beta testing and help us figure out and work through the kinks and that type of thing. And if that interests you at all, just reach out to me at ben@walkthrough.co. And you can also like DM me on Instagram or something at BG Bartolome. And yeah, thank you guys so much for your time and listening. And hope to hear from you soon. Be in touch.